Suppose there are two partners A and B sharing profits and losses in the ratio of 3:2. And this is the balance sheet as on 31st March 2010. I mean to say this is the balance sheet of A and B. On liability side, A's capital 30,000 rupees, B's capital 30,000 rupees, reserve fund 10,000 rupees, creditors rupees 10,000, and the total is 80,000. Asset side, building 40,000, cash 15,000, profit and loss count 5,000, furniture 20,000 rupees, and the total of the assets is rupees 80,000. On the same date, C comes as a new partner for 1/4 share. He brings 20,000 rupees as capital and 5,000 rupees as goodwill. Means he brings total 25,000 rupees. No need to explain that he brings capital because he is going to be entitled to the assets in future, and he brings cash for goodwill because he has to compensate the sacrificing shares, because whenever there is admission of a new partner, the new partner gains and the old partner has to sacrifice. So the gaining partner has to compensate the sacrificing partner. This is the basic principle. You have already learnt in our previous segments. And when the new partner was admitted, it was decided to appreciate building by 20% and depreciate furniture by 10%. And the goodwill money was withdrawn. So this is the question and we have to solve it. You know what are the steps you have to take at the time of solution of the question. I mean to say this admission of a new partner. First of all, set all the ratios. I mean to say old ratio, sacrificing ratio and new ratio. Then distribute all the accumulated profits, distribute all the accumulated losses, then all entries of revaluation, then the entries of admission, then entries of goodwill. Then you have to prepare the ledgers. First of all, revaluation account, then capital accounts, then cash account, and after that you have to prepare balance sheet. So first of all, we are going to set the ratios. You know there are two partners A and B, and their old ratio was, as per our question, that was 3:2. The question is silent, so we'll assume that sacrificing ratio and old ratio is the same. So sacrificing ratio 3:2. Now new ratio. You know C is coming for 1/4 share, so the difference between 1 and 4 is 3. So 3 will be multiplied by 3, it is 9. Then this 3 will be multiplied by 2, that is 6. Then 3 plus 2 is equal to 5. 5 multiplied by 1, 5. So the new ratio is 9:6:5. Now we'll start journal entries. First of all, we have to distribute all the accumulated profits. Look at the balance sheet. Is there any accumulated profit? Yes. There is a reserve fund of rupees 10,000. This is the accumulated profit. It means the firm made a profit of rupees 10,000, but this profit was not transferred to capital accounts. But you have to transfer it now before the new partner is admitted. So the journal entry will be reserve fund account debit rupees 10,000 to A's capital to B's capital, and the amounts will be 10,000, 6,000, 4,000. This profit has been distributed in the ratio of old ratio. One thing more, the reserve fund is on liability side. It means it has the credit balance. If you want to remove any item which is carrying credit balance, you have to debit it. So we have debited reserve fund rupees 10,000. So in this way, reserve fund is removed from the balance sheet and A and B's capital accounts have been credited. It means we have increased the balance of A and B. Now the next entry. Distribute all the accumulated losses, and accumulated losses are always on the asset side. So let's have a look at the balance sheet on asset side. Is there any accumulated loss? Yes. There is profit and loss account of rupees 5,000 on asset side. It means this is the accumulated loss. You have to distribute and you have to remove this item from the balance sheet. Profit and loss count on asset side, it means it is carrying debit balance. So you will have to credit it. So to profit and loss count, rupees 5,000, and A's capital account debit, B's capital account debit, 3,000 and 2,000. In this way, profit and loss count has been credited. It means it has been removed, and A's and B's capital accounts have been debited. It means we have reduced the balance of capitals. So accumulated profits are finished, accumulated losses are finished. Now we'll pass the journal entries of revaluation account. So the journal entry will be building has been appreciated by 20%, and the 20% of 40,000, that is rupees 8,000. So the journal entry will be building account debit to revaluation account rupees 8,000. Be careful. The building has been increased. When the asset is increased, there is a gain. So we have debited building account. It means we have increased the value of building in our books, and revaluation account has been credited. What it means? It is a gain, because revaluation account is a nominal account. Whenever we credit nominal account, it means we want to show that there is a gain. Now, furniture has been depreciated by 10%. 10% of 20,000 is rupees 2,000. It means we are going to reduce the value of asset, and that asset is furniture. It's a loss. So in case of loss on revaluation, revaluation account is debited. So revaluation account debit rupees 2,000 to furniture rupees 2,000. Furniture account has been credited. What it means? We have reduced the value of furniture by rupees 2,000, because furniture is always shown on the asset side. It carries debit balance. If we want to reduce the value, we will have to credit. Now I'm going to leave space for one journal entry for the loss or profit on revaluation account, because this amount can be found out only when we prepare the ledgers, and we will prepare the ledgers when we have completed all the journal entries. So I'm going to leave space for one journal entry. Next journal entry. Now the new partner is coming. So I'm going to assume that before the admission of new partner, all entries we have to pass, we have done it. Now the new partner is coming with rupees 25,000 rupees. So cash account debit to C's capital 25,000 rupees. You know, out of this 25,000, 5,000 belongs to A and B, because 5,000 has been brought by C for the compensation to A and B, because they have sacrificed. That's why he has brought rupees 5,000 as goodwill. So C's capital account debit to A's capital to B's capital, and the amounts will be 5,000, 3,000, 2,000. Be careful. This is the adjustment entry for goodwill, and this journal entry is always passed in sacrificing ratio, and our sacrificing ratio is 3 is to 2. One thing more, we have been provided one extra information, and that is that the goodwill money was withdrawn. You know, C has brought rupees 5,000 and this 5,000 has been transferred to A and B's capital account. So A has got 3,000, B has got 2,000, and they withdrew the goodwill money. What it means? Whatever they have got on account of goodwill, that money has been taken by A and B. If any partner takes out cash from the firm, that is called drawings. So we have to pass the journal entry of drawings, and that will be A's capital account debit, B's capital account debit to cash account. A will take 3,000, B will take 2,000, and to cash 5,000. It means the money has been withdrawn. Basically, it is a journal entry of drawings. So it doesn't matter if any partner takes out money from the firm, whether on account of goodwill or profit or whatever it is. Technically, it's a journal entry of drawing. And the journal entry for drawings is always capital account debit to cash account, and we have done the same thing.